Welcome back, class. This is chapter 13, and this is leveraging capital structure. One of the things that we're going to talk about in this chapter is the capital structure of a business and how that's set up, the relationship between debt and equity. And when we look at the capital structure question, we were looking at in chapter 12 the weighted average cost of capital and thinking about what that cost was. Basically looking at what the minimum return or expected return was on the assets in order to make that net present value positive rather than negative. Well, when we look at the capital structure, we want to minimize the weighted average cost of capital so we can maximize the value of the firm. We can look at the effect of financial leverage through a case that they present to us here in chapter 13, where they focus on what happens when a company basically takes on some additional debt to retire some of its capital stock. So in this scenario, you have a company without debt in table 13.1, and they're going to take on $4 million in debt to retire half of their stock. When they do that, they have a proposed structure that looks like this rather than the current structure that looks like this. So what we want to do is compare those two structures to see what happens in the case where they've actually adopted that proposed structure. What impact will it have on their important data in the financial statements? So when we look at it, we look at what are the possible scenarios if we do take this on. Now we know what we're at currently and what we expect to do next year. But what happens if we hit a recession and our sales drop in half, or our earnings before interest and taxes drop by 50%? Well, if it does, you'll see that we have a negative impact with return on equity and earnings per share compared to what it would be without the debt. However, if we're performing as expected, you'll see that there's a little bit of a bump here with the debt, where it increases slightly for return on equity and earnings per share, but the biggest impact is if we're expanding. If the business is growing, we see a much higher return on equity and earnings per share with the debt than without. Now, when we think about that, this is the way it looks on an analysis where we're looking at the break-even point. So we want to calculate what the break-even point is. And they basically are telling us here that at the break-even point, what that is at the break-even point, we're going to be exactly at the same outcome for both options. So we have an equal return on equity and earnings per share for both with the debt and without the debt. Then if we move into expansion mode, we see that with the debt we have a greater return on equity and earnings per share. But if we drop below that break-even point, we see the bigger negative impact here as well. That doesn't mean that we shouldn't have debt. It just means that we need to be aware of the difference between what happens with it and without it. And so when we're calculating a break-even point, here's how you calculate it. You take the earnings before interest and taxes divided by the 400,000 in the case where you have the debt, in the case where you don't have the debt, and that's equal to earnings before interest and taxes minus the 400,000, which is the interest payment, divided by 200,000. So this is the case scenario without the debt. And then earnings before interest and taxes is going to be 2 times this impact right here, which means that earnings before interest and taxes for the break-even point is going to be $800,000. When earnings before interest and taxes is $800,000, the earnings per share is $2 under both structures. So that's the break-even point. That's where you have a similar result with both cases. Now, when we looked at these tables and these figures, the owner of this business in this case decided, well, whether or not to do this. Well, she observed these 3 things, that the effect of financial leverage depends on the earnings before interest and taxes. And if you're in an expected scenario, you're going to have a positive result. But the problem is that if things happen negatively, the shareholders have a greater risk under that proposed structure where there's debt involved. So here's an example, or here's the table where you have both of these original structures, but then you're going to add in the impact of homemade leverage. Now here's the thing. When we're looking at this, we have the proposed capital structure here, the earnings per share, and the earnings for 100 shares. What we're talking about with homemade leverage is a shareholder replicating what would happen if they took on the debt in their case with their shares of stock. So for example, if a shareholder owns 200 shares of stock, and this is the example here, and if the company would purchase back half the stock, it would be the same as if the shareholder doubled their investment in the company. So basically what they're doing is when they purchase back the stock, they're cutting the number of shares outstanding. The shareholders' ratio to the total shares of stock doesn't change, but the impact per share does. So what can the shareholder do? Well, the shareholder can go out and borrow some additional money to purchase enough shares to make their part of their payback on the shares the same as if what would happen under the scenario with debt. So if they borrow 200,000 or 2,000 and buy 200 more shares of stock, what you're going to see is that they're going to have magnified the impact of these returns for the shares of stock that they own. In other words, the company didn't change the shareholders' participation in the shares, but the shareholder, by doubling their investment, has recreated what would have happened if the company would have reduced the total number of shares outstanding. The shareholder cannot reduce the number of shares, but they can increase the shares that they own. So that's what's happened here. They've recreated the debt-equity ratio that they have in their investment on their own, because they've got an equal number of shares that they originally purchased with a number of shares that they have because of debt. So does that make sense? I hope that makes sense. Anyway, homemade leverage is essentially where you recreate a scenario where you can get the same payback on the shares of stock that you own as in a case where the company does not go forward with debt. You can recreate that scenario by buying additional shares. Okay, then when we talk about capital structure and the cost of capital or equity capital, we're going to look at ways that relationship interacts. So we're going to have a ratio between stocks and bonds. And here they have the M&M proposition that they talk about. Remember, in weighted average cost of capital, what we're looking at is the total equity we have divided by the value times the expected return on equity plus the debt we have divided by the value of the firm or by the value times the return on debt. So the value, or the value of equity, or the total equity of the firm, is going to be the equity plus the debt. That's where we get the total capital. So we're talking about those things. We look at here, we're looking at solving for the cost of equity capital. We have the return on equity, required return on equity is equal to the required return on assets minus the required return on debt times the debt equity ratio, so the debt divided by equity. Anyway, when we look at this, here's what we see. We have the return on equity that we anticipate, the weighted average cost of capital that includes both equity and debt. This would be the weighted average cost of capital minus the required return on assets. and here's the required return on debt. Essentially, what we're doing in analyzing this is we're showing that debt is less expensive than capital, and it is. So let's look at a case. And when we're talking about this cost of equity capital, the Ricardo Corporation has a weighted average cost of capital of 12%. It can borrow at 8%, assuming that Ricardo has a target capital structure of 80% equity and 20% debt. What is the cost of equity, and what is the cost of equity if the largest capital, or if the target capital structure is 50% equity? So when we calculate the weighted average cost of capital, or when we look at this, we're going to look at the cost of equity here. The cost of equity is equal to the required return on equity is equal to the required return on assets plus the required return on assets minus required return on debt times the debt equity ratio. And here we have that is equal to 12% plus 12% minus 8% times the debt equity ratio of 0.25, and we have the cost of equity at 13%. So when we're looking at the next scenario in the case, we want to look at weighted average cost of capital. We're assuming that the percentage of equity financing is 80% and the cost of equity is 13%. The tax rate is 0. So in this scenario, this is the formula we use. We use the equity divided by value times the return on equity plus the debt divided by value times the return on debt. So we have 80% for this ratio of equity divided by the total value of capital. And we're going to have that times the required return of 13% on equity, the cost of equity, plus 20% debt, which is the debt total value ratio, times 8%, which is the required return, or basically the cost of debt. We get a weighted average cost of capital of 12%. If we move that then, if we move that down where we have the percentage of equity financing at 50%, the cost of equity then moves up to 16%. And then what we have here is this weighted average cost of capital is this. We take again the equity divided by the total value of capital times the return on equity plus the debt divided by total value of capital times return on debt. So we have 0.50, that's the ratio of equity, times the 16%, which is what this would increase to. The cost of equity would increase to under this scenario, plus 50% of, because that's the debt equity ratio here, 50% or debt total capital ratio, and that's 50% times the 8% cost of debt, and we get a 12% overall weighted average cost of capital. So the weighted average cost of capital doesn't necessarily change, but the components of it do. We're talking about financial risk when we're talking about cost of equity, and basically that's going to be determined by the structure of the business and how we structure the debt equity ratios. When we're talking about the capital structure, taxes do have an impact, and that's because if we have borrowings or debt, usually the interest is deductible and the dividends we pay out for equity shares is not deductible. So we can have a positive impact with debt on taxes, and we call that the interest tax shield. So if we look at two different structures, we'll see that the first firm has taxes of $300 and a net income of $700. Firm L has taxes of $276 and total net income of $724. What's happening here is the second firm has debt, and that debt shield or interest tax shield is this $24 difference. The cash flow, if we're looking at the cash flow to stockholders and bondholders, we see that here. and that is a little bit different in Firm L than it is in Firm U. But the total cash flow is $24 more to both stockholders and bondholders because of that tax shield that we were talking about earlier. They calculate the present value of the tax shield here. The corporate tax rate times the debt times the required return on the debt, or the cost of debt, divided by the required return or cost of debt, is equal to the corporate tax rate times this debt. So what we have in this situation is that we've calculated the benefits of carrying debt in a firm. There are some benefits, and this is the tax benefit. Here they're showing the present value of the tax shield on debt compared to the firm without debt, and you'll see as the value of the firm will increase with increases in that tax shield. So if you have cases where you're dealing with corporate taxes and things like that, and all companies do, some level of debt is going to be beneficial to the company. Okay, now bankruptcy is an issue where you have more debt than you can pay back, or you have too much debt, or if you get into a difficult situation with debt where your earnings are not what you anticipate them to be. And there are direct costs in bankruptcy, which means basically the firm that goes bankrupt, there are going to be direct costs to the shareholders and bondholders as the firm is liquidated. Or if it's not liquidated, they go through restructuring, and the restructuring generally does have a negative impact on stockholders and possibly bondholders as well. But basically bankruptcy is for a firm in financial distress. And that can mean that their earnings are less than what they anticipate, and that these firms are going through a particularly severe period of time. As the firm goes through the bankruptcy process, asset loses value. Well, let me just say, before the bankruptcy process, the assets are going to lose value because the firm is trying to cover its debt. And then there's some indirect, these are part of the indirect costs when we're going through that financial distress. Whether or not the firm actually goes bankrupt or not, there are some indirect costs related with going through those periods of struggle. Now, we've talked about the possibility of an optimal capital structure where the return is at its maximum. Basically, what we were looking at above was a static theory of capital structure. That is, it's going to be the same, it's going to be relatively equal across different scenarios. So we're going to have a static theory because it assumes that the firm is fixed in terms of assets and operations. Now, if we were looking at a graphing of how this static theory would work out, we look at it like this. This is going to be fairly straightforward. So in figure 13.6, you'll see three possible scenarios that are painted out in this diagram, in this figure. In case one, where you don't have taxes or bankruptcy costs, the value of the firm and the weighted average cost of capital are not affected by capital structures. In that case, what you see is this red area right here where nothing really changes. Basically, the firm's value is consistent across the board. In case two, you have corporate taxes and no bankruptcy costs. The value of the firm is increasing and the weighted average cost of capital decreases as the amount of debt goes up. And that's this one where you have the straight arrow here in the green. In the blue, we have case 3, which is where corporate taxes and bankruptcy costs you have. The value of the firm reaches a maximum and then the optimal amount of borrowing, and at the same time, the weighted average cost of capital is minimized. So what you have is a curve rather than a straight line. So you have a point where it's optimal right here, but if you continue to do that, it's not going to be optimal. It's going to decline. So you have a net gain from leverage up to this point, but once you go beyond that point, it's a negative impact. All right. So when we're talking about these capital structures, we need to consider that the static model really doesn't describe or is not capable of identifying optimal structure, but it does point out two of the more important factors, that's taxes and financial distress. And taxes, you benefit from leverage because you reduce the amount of taxes you're going to pay to the government with leverage because of the interest deduction. With financial distress, when you go into when a firm is entering in this financial distress period, costs are magnified, and the impact, and that's where you're in the downhill side of this curve that you saw in case 3. So what actually is a good capital structure? Well, it depends on the industry that you're in. So for example, here are a list of different kinds of industries and the ratio of debt to total capital and the ratio of debt to equity. So for the electric utility company, you can see they have a lot of debt. They have a very high ratio of debt to equity. And that would be because they have a very high investment in equipment and lines and things like that. There's going to be a very significant amount of assets that they have to acquire in order to make this company work. In other words, there's a significant capital investment involved here. And so that's probably going to require a much higher level of debt, because a lot of that you won't be able to cover it all, both equity. When we're talking about computer equipment companies, look at this ratio. They're a much lower ratio, and then some of that may be due to the fact that a lot of what happens in that industry relates to research and development. And you'll see a similar, when we talk about total capital ratio of debt to capital, you'll see a high level of this same ratio in similar companies to the electric company, like the pay television company. But look at this for airlines. There's a very high ratio of debt to capital. And that would be, we would expect that to happen with them, because when you look at the purchase of an airliner or the cost of an airplane, you're talking about a very, very significant cost of purchasing equipment. So there's going to have to be some level of debt involved in that. You won't be able to do it all with equity. Motor vehicles, a fairly low ratio of debt to total capital. And that might be because this is a more mature business where you have older companies that have been around for a long time. And you'll see in retail businesses where there's a lower ratio. Pharmaceutical companies here, a very low ratio, and that's because a lot of the value of that firm is in the patents, or basically the patents that they have for these different drug components that they've invented. So a lot of this is research and development, and so you'll see that. But anyway, those are different firms and some of the different ratios you'll see in them. What happens in the bankruptcy process? Well, there are a couple of things that can happen when you go through bankruptcy. A firm, individual too, but this is related to a company. If a business fails, what that means is they have a loss to their creditors, but even not just a firm with a lot of debt can go into bankruptcy. Even firms that have a lot of equity can go into bankruptcy. When we're talking about bankruptcy, it's a legal proceeding basically that liquidates or reorganizes a business, and there can be reasons for going into bankruptcy other than debt. And there can be a technical insolvency when a company is unable to meet obligations, and an accounting insolvency where you have a negative net worth, where a company really doesn't have a positive net worth or doesn't have any net working capital. Going through bankruptcy typically is Chapter 7 in the Bankruptcy Reform Act 78. That's really liquidation. When you're doing that, you're basically liquidating the company and selling whatever assets there are and liquidating what you can to the people or the creditors. In the distribution of the proceedings, there's a specific order of lists. So this is the order that you would pay out those obligations. This is a priority list. But firms have entered into bankruptcy organization that are not necessarily insolvent. And a reorganization is in Chapter 11 of the Code. And in this case, you can file a voluntary petition. You want to reorganize, and you basically go through this reorganization in order to improve the financial strength of the company. You're not really bankrupt, not necessarily. I mean, you can be. So they talk about Lehman Brothers, which filed for bankruptcy during the financial crisis. So they did come through that. But there are others who have gone through it as well, and they talk about those here. When you look at what Lehman Brothers costs were in bankruptcy, they were $2.2 billion. Then the next one in line after Lehman Brothers involved Enron, and the fees in that bankruptcy were $1 billion. But both of these companies were involved in accounting issues that were definitely questionable, and the practices that they engaged in were definitely not necessarily straightforward, that there were a lot of other things going on in these companies that brought them to this case of bankruptcy. Now, there are firms that go through bankruptcy in order to gain an advantage, and they talk here about Trump Hotels and Casinos having filed for bankruptcy 3 times in order to go through the process of improving the firm's financial strength. And basically what they're doing with that is that they are what they call cramming down certain conditions on the creditors. So basically the creditors have this, well, if I don't do this, then I'm not going to get any money out of them. So that's really what they do that for. Well, there have been other cases, not just Trump, but if you look at other cases historically, one of the most, Trump did this 3 times, but another company did the same thing, and that was Continental Airlines with Frank Lorenzo, who was the CEO in the 1980s. And Lorenzo basically used the bankruptcy court in order to renegotiate wage agreements with his employees. He didn't like the airline pilots' pay rates, so he went through bankruptcy 3 times, or well, at least 2 times with Continental, I believe a 3rd time as well. But he went through here it is, Continental. He went through bankruptcy twice to renegotiate those airline pilots' wages to cram them down. Because he didn't like the rates that they were paying. They were not insolvent. Continental Airlines were not insolvent, but Lorenzo did this twice with Continental. They terminated labor agreements and reduced their workforce, and basically forced their employees to take a much lower wages, and primarily it was related to airline pilots. So I only know that because I wrote a research paper related to Continental at one point. Anyway, there are agreements to avoid bankruptcy, and then the legal process is long and it can be complicated, and there can be agreements that they can enter into with creditors if they want to avoid that process. The company really does spend a lot of money on bankruptcy fees if it goes through that process. But anyway, if you look at that and you say, okay, what can I do in order to avoid the fees? And the creditors look at what can I do to avoid the loss, they may enter into an agreement rather than going into bankruptcy. Okay, we're going to get to the assignments here. In these assignments for Chapter 13, you're going to answer questions and problems. We're going to look at problem number 1, number 3, and number 5, and then also number 8. So let me look at this and kind of guide you through this. In problem number 1, we're talking about earnings before interest and taxes and leverage. This company has no debt outstanding, a market value of this. Earnings before interest and taxes are projected to be this if economic conditions are normal. If there's an expansion, they'll be 20% higher. If there's a recession, it'll be 35% lower. What they're asking you to do is to do what they showed you in that table 13.2, where a company basically looked at different scenarios, calculating earnings per share under each of the 3 economic scenarios. If there's any debt issued, before any debt is issued, also calculate the percentage of change in earnings per share when the economy expands or enters recession. So for each of those 3, you're going to calculate the increase or decrease in earnings per share, earnings before interest and taxes. Then you're going to repeat that, calculating it with debt if they issue the debt. Okay, number 2, you're going to repeat this scenario here in problem 1, but you're going to assume the company has a tax rate of 35%, so you're going to show the tax shield effect there. And then with number 3, you're going to calculate return on equity and leverage, and they're going to give you the scenario, and you're going to use the same company you did in number 1, but you're going to alter the calculations a little bit. Then number 8 is where you calculate homemade leverage, and they ask you to actually look at how a person can basically replicate or create homemade leverage. Okay, that's it for Chapter 13, and I'll be putting a video up shortly.